The notification hits your screen before sunrise. A red number. Margin utilization at 87%. Jonathan has been awake since 5:12 a.m., not because he had to be, but because the positions don't sleep. 3 tabs are open, a cash flow sheet, a brokerage dashboard, and a draft email he hasn't sent. The room is quiet. The city isn't fully online yet. Jonathan is 24 years old. He earns $62,000 a year. He owes $38,400 across 2 credit lines. His savings account shows $3,912. He runs the numbers again. Nothing is technically broken. Everything is structurally tight. He doesn't panic. He adjusts. He moves $1,200 from savings to reduce utilization. He delays a payment by 3 days. He recalculates interest at 19.8%. The numbers settle. Not better. Just stable. He closes the laptop. He opens it again. This is where it starts. Jonathan trades time for money. Precisely. Repeatedly. His salary arrives every 2 weeks, $2,384 after tax. Fixed. Predictable. He builds his life around it. Rent is $1,050. Utilities average $220. Transport $180. Food $400. Minimum debt payments $960. There is no margin. Only sequencing. Jonathan learns quickly that effort doesn't scale. Hours do, and hours have a ceiling. He takes on extra work. Freelance data cleaning at $35 an hour. 10 hours a week. It adds $1,400 a month before tax. It feels like progress. It isn't leverage. It's extension. At work, Jonathan becomes efficient, not visible. Efficient. He completes tasks in half the expected time. He doesn't tell anyone. He uses the extra time to learn. Basic accounting. Cash flow modeling. He reads filings at night. He stops asking why. He starts asking how. One evening, Jonathan finds a discrepancy, a vendor contract misclassified. $72,000 booked incorrectly. It changes nothing for the company. It changes his understanding. Errors are not rare. They are distributed. He corrects it quietly in his own file. He doesn't escalate. Not yet. The first rule is simple. Effort is linear. Systems are not. Jonathan starts looking for systems. Jonathan's income changes, not dramatically, but structurally. He moves into a financial analyst role at $84,000 base with a 10% bonus target. He now sits closer to decisions, not inside them. He builds models others present. His work travels further than his name. Jonathan manages a budget line of $6.2 million in annual spend. He doesn't control it. He monitors it. Variance analysis becomes his language. He explains movements without context because context isn't requested. Jonathan begins investing. Not aggressively. Systematically. $1,000 per month into index funds. He opens a separate account for discretionary trades with $8,500. He loses $1,200 in the first 3 months, not from volatility, but from impatience. He adjusts. He reduces frequency. He defines rules. Max 2% risk per trade. No exceptions. He follows them. At work, a senior manager questions Jonathan's model. Revenue projections are inflated by 4.8%. He explains the logic. He is asked to adjust the narrative, not the numbers. Jonathan understands. The system doesn't reject error. It absorbs it. His bonus comes in at $7,600. He reduces his debt to $19,000. For the first time, the trajectory changes. The second rule becomes clear. Accuracy is valued. Alignment is rewarded. Jonathan begins to align. Jonathan's compensation crosses six figures. $118,000 base and $32,000 bonus. The numbers feel larger, but the constraints shift. Jonathan stops thinking in expenses. He thinks in allocation. He manages a small team now. 2 analysts. Their output becomes his input. Their errors become his responsibility. He reviews faster than he used to build. He doesn't correct everything, only what matters. Jonathan is brought into deal support. A $240 million acquisition. He builds the operating model. Growth assumptions, margins, debt structure, exit multiples. Jonathan knows which assumptions are optimistic. He keeps them. The deal needs them. He sits in on calls, not speaking, just listening. The conversation is not about numbers. It's about certainty. Confidence is priced higher than precision. Jonathan starts building relationships. Not friendships. Relationships. A director who forwards him work. A peer who shares information early. He exchanges value quietly. Jonathan's net worth turns positive at $42,000. He increases his investments to $2,500 per month. Compounding becomes visible. He begins structuring his own small deal. A $75,000 investment into a logistics startup for 12% equity. He negotiates terms he learned weeks ago. The founder accepts. The third rule settles in. Control flows to those who structure the terms. Jonathan starts structuring. Jonathan is no longer supporting deals. He is sourcing parts of them. His title changes. Manager. His compensation rises to $165,000 base with $90,000 variable. Jonathan stops relying on fixed income. He builds a network that produces opportunities. A private equity associate shares pipeline access. A founder calls him before raising. Information arrives earlier. Jonathan recognizes patterns. Companies don't fail suddenly. They deteriorate in signals. Cash flow tightens. Receivables stretch. Language shifts. He acts before announcements. Jonathan co-invests $250,000 in a $12 million round. He syndicates $1.4 million from contacts and takes a 2% carry. He is not the largest investor. He is the connector. At work, Jonathan loses a $680 million mandate, not on numbers, but on relationship. He analyzes it. It wasn't skill. It was proximity. Jonathan adjusts. He repositions himself. His assets cross $1.1 million, mostly illiquid. He reduces liquid risk. He increases optionality. A deal appears profitable on paper but fragile in reality. Jonathan proceeds anyway. The downside is externalized. The upside is internalized. He notes the asymmetry. The fourth rule becomes clear. Information arrives unevenly. Advantage lies in timing, not insight. Jonathan prioritizes timing. Jonathan's role evolves again. Director. He manages revenue, not just cost. His book generates $4.8 million in annual fees. He is responsible for maintaining it. Clients call him when it matters. Jonathan oversees multiple transactions, a $1.3 billion infrastructure financing, a $420 million restructuring. He doesn't build models anymore. He interrogates them. He asks where they break. Jonathan sits in credit committees and votes on exposure. A $300 million facility to a deteriorating borrower. The metrics are weak. The relationship is strong. Jonathan votes yes. The decision is not financial. It is strategic. He travels across financial centers. Conversations remain consistent. Risk is discussed. Relationships decide. Jonathan's portfolio grows to $6.7 million. He diversifies. He structures. He uses leverage carefully, not to amplify returns, but to optimize structure. Language changes around him. Profit becomes outcome. Risk becomes exposure. A deal restructures pension obligations and improves returns. Jonathan understands the downstream impact. He doesn't quantify it. It isn't required. The fifth rule becomes evident. Decisions are framed financially. Consequences are distributed socially. Jonathan focuses on the frame. Jonathan becomes a partner. Equity in the firm. Carried interest in the fund. His compensation shifts from annual to cyclical. He thinks in 5-year horizons. Jonathan leads a $3.6 billion acquisition across multiple jurisdictions. He coordinates legal, tax, and financing structures. He doesn't see the full system. No one does. He manages his part. Jonathan co-invests $4 million personally. Alignment is expected. His network compresses. Fewer people. Higher stakes. Conversations become shorter. Decisions become faster. Jonathan gains access to information before it becomes public, not illegally, but structurally. He selects what matters. His net worth crosses $28 million. He stops optimizing for maximum return. He optimizes for controlled downside. A sovereign co-investor offers him access to a $900 million allocation. Jonathan anchors $60 million. The terms are favorable because of relationship, not performance. He accepts. The sixth rule becomes clear. At scale, access compounds faster than capital. Jonathan protects access. Jonathan's title begins to matter less. His name carries weight. He sits on boards. He advises more than he executes. His influence expands across sectors. He allocates across billions. He receives calls for perspective. He provides it briefly. Jonathan understands that markets move on expectation, not data. Data confirms. Positioning precedes. He adjusts portfolios before consensus forms. Incrementally. Quietly. Jonathan's holdings exceed $90 million. Complexity increases. He observes outcomes at a distance. Layoffs, expansions, consolidations. They register as metrics. Not events. He measures stability of structure more than return. The seventh rule settles in. When Jonathan influences the system, objectivity becomes internal. He operates within it. There is no formal title that captures Jonathan's position now. He allocates through a family office across regions and asset classes. He deploys billions selectively. His circle is small. Information flows both ways. Jonathan identifies shifts before they materialize through pattern recognition. Liquidity tightens. Policy shifts. Capital moves. He positions accordingly. Quietly. Jonathan's net worth exceeds $400 million. He rebalances instead of reacting. He attends fewer meetings. The ones he attends are decisive. He speaks briefly. Others adjust. The system is no longer external. It is embedded. The final rule becomes clear. Positioning defines outcome more than action. Jonathan maintains position. A screen lights up in a small apartment before sunrise. A red number. Margin utilization at 87%. A 24-year-old sits in front of it. His name is Jonathan. He moves $1,200 between accounts, delays a payment, recalculates interest. The numbers stabilize. He closes the laptop. He opens it again. He thinks this is about income, about effort, about discipline. He hasn't seen the structure yet. He will. The system doesn't announce itself. It reveals in layers. One adjustment at a time. One decision at a time. The market opens. The numbers move. The positions hold. Another entry point. Another iteration. The cycle continues.